Hello everyone and welcome to Study IQ English. I am Joycey Joy. In this video, we will be discussing about money supply, the concept of money supply. Let's get started. First, let us see what is money. Money is accepted as a payment for goods and services and repayment of debts. That is, whatever medium is accepted as a payment for goods and services. When you purchase any good or a service, when you pay for it, the medium through which you pay for this goods and services can be considered as money, and also the medium through which you make the repayment of debt or the borrowings. If you have borrowed the money and when you make the repayment, the medium through which you make the repayment can be considered as money. Now, this term is very important, legal tender. Currencies that are issued by the RBI or by the government are considered to be legal tender. What is meant by legal tender? Legal tender means that if you make a payment using that money, which is a legal tender, nobody can refuse to accept that payment, which means that it is acceptable for everyone or nobody can refuse to accept it. So legal tender cannot be refused by any citizen of the country for settlement of any kind of transaction, and it can be either limited or unlimited. So it can be either a limited transaction or an unlimited transaction. Nobody can refuse to accept the payment. Now let us come to different types of money: commodity money, fiduciary money, and fiat money. Commodity money derives its value from the intrinsic value of the commodity. That is, for example, a gold coin. The value of the gold coin as a commodity is 5,000, and as a currency also the value is 5,000. So this is commodity money, or we also call it as a full-bodied money, which means that that particular currency as a commodity as well as a currency has the same value. That is commodity money. Next is fiduciary money. Money which gets accepted due to mutual trust between the parties. That is, between two parties, the money that is accepted due to mutual trust. Next is fiat money. Money which does not have any intrinsic value of its own and declared as a legal tender for all the transactions within a country. So what is fiat money? Money which does not has any intrinsic value. Money which does not have any intrinsic value of its own. That is, as a commodity, there is no value for that money. And it is declared as legal tender. But it is legal tender, which means that it is accepted as a means of payment and settlement. And coming to RBI, in the previous video, we discussed about RBI as the central bank and the role of RBI as well. So RBI is the sole authority, the only authority to print currency notes under the RBI Act of 1934, which print notes of different denominations from rupees 2 to 10,000. So RBI, or the Reserve Bank of India, is the sole authority or the only authority in order to print currency notes under the RBI Act of 1934. Government of India issues 1 rupee notes and coins under the Coinage Act of 2011. See, this is important. The Government of India, that is the Ministry of Finance, Finance Ministry, issues 1 rupee notes and coins under the Coinage Act of 2011. Now we are coming to money supply, and we will see different measures of money supply. First, we are coming to reserve money, that is M0. Reserve money is also called as the high-powered money, or it is also called as base money, which is M0. It is currency in circulation in the market or in the economy, plus the bank's deposits with the RBI, that is the deposits of the banks with the RBI, other deposits with the RBI. All these makes for M0. Next is M1, which is narrow money. M1 is currency with the public plus deposit money of the public. That is current deposits with the banking system, demand liabilities portion of the savings deposits with the banking system, and other deposits with the RBI. So all these makes the M1. See, if you see the components of M1, they are highly liquid in nature, which means that M1 is liquid, or the liquidity of M1 is very high. So in case of M1, the liquidity is very high. Now coming to M2. M2 is intermediate money, not very liquid and not very broad. So it is called as intermediate money because financial assets included in this category are more than those included in M1 but less than in case of M3. M1 is also called as narrow money. See, it is also called as narrow money, whereas M3 is called as broad money. What would be the reason? M3 is called as broad money because there are so many components, large number of components in M3. This is because of the large number of components in M3. And why is M1 called as narrow money? M1 is called narrow money because there are less components in M1. Because of the less components in M1. And in between M1 and M3, we have M2, which is intermediate money, which doesn't have as much as components as in case of M3 and not less as in case of M1. So M2 or intermediate money is called as intermediate money because there are less financial assets included. M2 is M1 plus savings deposits with post office savings banks. That is M2. Now we are coming to M3. It is M1 plus time deposits with the banking system. So M1, which is liquid money or narrow money, plus the time deposits with the banking system makes for M3. M3 equal to net bank credit to the government plus bank credit to the commercial sector plus net foreign exchange assets of the banking sector plus the government's currency liabilities to the public minus net non-monetary liabilities of the banking sector. So this is M3. Now if you see this M0, MB, M1, M2, M3, this will give you an idea regarding the money supply. Now next we are coming to a concept called liquidity trap. We will see what is the concept of a liquidity trap. During liquidity trap, an expansionary monetary policy becomes ineffective. So what is liquidity trap? It is a situation when the expansionary monetary policy becomes ineffective. So expansionary monetary policy is a monetary policy through which the RBI tries to increase the money supply by reducing the interest rates. Now what is the purpose of RBI in reducing the interest rates? RBI wants to create more demand for money or credit. How? By reducing the interest rates. When the interest rates are less, the demand for credit will be very high and therefore the money supply in the economy will increase. So during a liquidity trap, an expansionary monetary policy becomes ineffective. When a country is trying to recover from a recession and the government aims to boost the investment in the nation by reducing interest rate, it is called as liquidity trap. See, when an economy is trying to recover from recession, how can an economy recover from a recession? That is by increasing the money supply. So, by increasing investment, money supply, demand, etc., an economy can recover from a recession. And for that, the government tries to increase the investment in an economy. For that, the RBI, as the monetary authority of the country, tries to reduce the interest rate in order to increase the liquidity in the market. So, in this process, what happens is that monetary policy has become ineffective because nobody is demanding for credit even if the interest rates are less. This situation is called as a liquidity trap. Due to prevailing depressed demand and production levels, individuals prefer storing their money in the advent of weakening economic conditions. People want to save their money. People will prefer to save their money or to increase their savings. This is called as liquidity trap. Next, we are coming to paradox of thrift. States that as individuals try to save more, it leads to fall in aggregate demand and hence fall in the economic growth. This is called as paradox of thrift. When people prefer to save their money, when the people are trying to save more money, it will lead to a fall in the aggregate demand and therefore what will happen? There will be a fall in the economic growth, and this is popularized by John Maynard Keynes. The Keynesian theory proposes this theory of paradox of thrift. So this is about paradox of thrift and liquidity trap. So that's it about the money supply and related terms of money supply. Thank you so much for watching. I wish you all the very best.